Hello everyone, welcome back to the channel. Today I want to focus on a market development that, in my view, could become one of the most important macro stories of the second half of August. Oil is rising again. Brent crude has moved above $91 per barrel, while WTI is trading around $85. At first glance, this may look like a simple commodity story, but I do not think it is. When I look at the broader market structure, I see a chain reaction that potentially connects oil prices, inflation expectations, US Treasury yields, Federal Reserve policy, equity valuations, the dollar, and even gold. And the key question I want to answer today is this. If oil continues toward $90 and possibly beyond, could that create enough inflation pressure to force the Federal Reserve into a much more hawkish position than markets currently expect? Because if that happens, the consequences will not remain inside the energy market. They will spread across almost every major asset class. Before I begin, a quick reminder. Nothing in this video should be considered investment advice. I am simply sharing my own market analysis, the technical levels I am following, and the scenarios I think investors should keep on their radar. Now let me start with the most important development. Brent crude has risen by almost 3% to around $91.10 per barrel. WTI has also continued higher and is trading near $85. This move is happening at a sensitive moment. Geopolitical tensions are rising again. The diplomatic process between Washington and Tehran is facing renewed uncertainty, and tensions in Lebanon have also increased. Whenever geopolitical risk returns to the Middle East, I pay particular attention to oil because energy markets tend to react before the broader macroeconomic consequences become visible. But what makes this move more important is that oil is not rising in isolation. US Treasury yields are also moving higher. The 10-year Treasury yield has climbed to around 4.72%. The 2-year yield is near 4.18%. More importantly, the 30-year Treasury yield has reached approximately 5.31%, its highest level since 2007. That combination immediately gets my attention. Higher oil prices and higher long-term yields at the same time create a very different environment from a conventional economic slowdown. Normally, if investors become concerned about weaker economic growth, they might expect bond yields to decline as markets price in easier monetary policy. But what we are seeing now is more complicated. Oil is rising, inflation concerns are returning, long-term bond yields are rising, and US equities are beginning to lose some momentum near record highs. For me, that is the core of today's story. Let me explain why oil matters so much. Oil is not simply another commodity. Energy prices feed directly and indirectly into the economy. When oil prices rise, transportation costs increase, logistics costs rise, airline fuel becomes more expensive, manufacturing costs can increase, petrochemical inputs become more expensive. Agricultural production and distribution can also face additional cost pressure. Companies then have a choice. They either absorb those higher costs and accept lower margins, or they try to pass some of those costs to consumers. If those costs are passed through, inflation becomes more persistent. And persistence is exactly what central banks do not want to see. The Federal Reserve's problem is not just whether inflation falls for 1 or 2 months. The real issue is whether inflation can remain sustainably close to the Fed's target without another wave of price pressure emerging. This is why I think oil around $90 deserves much more attention than a simple headline about energy markets. If WTI moves through $90 and then starts approaching the next major technical area around $97.50, the market may begin to ask a much more uncomfortable question. What if inflation does not continue falling as smoothly as expected? And from there, the next question becomes even more important. What does the Fed do? I am not saying that a move in oil automatically means another rate hike. That would be too simplistic. The Federal Reserve looks at a much broader set of data, including core inflation, employment, wages, consumer spending, financial conditions, and inflation expectations. But oil can change the direction of the conversation. And markets are driven not only by what the Fed actually does, but also by what investors believe the Fed may have to do. That distinction is critical. If investors begin to price a more hawkish Federal Reserve, financial conditions can tighten before the Fed changes rates at all. Bond yields can rise, the dollar can strengthen. Equity valuation multiples can compress, credit conditions can tighten, and gold can experience conflicting forces between inflation demand and higher real yields. This is why I always try to think in terms of transmission mechanisms rather than isolated markets. Now, let me move to the technical picture in WTI because I think the chart is confirming that this is more than just a one-day geopolitical spike. On the daily chart, WTI is trading around $85 and has moved above all three major moving averages I am following. The 14-day moving average is around 81.65, the 50-day moving average is near 79.43, and the 200-day moving average is close to 78.11. This is important because the price is now above the short, medium, and long-term moving averages. More importantly, the moving averages are beginning to form a constructive bullish structure. When I see price recovering above the 200-day moving average after a prolonged decline, I pay attention. Earlier this year, crude oil had fallen dramatically from levels above $115 toward the low 70s, so this recovery is happening after a substantial correction. The market is not starting from an extended multi-month bullish position. It is trying to rebuild trend structure from much lower levels. That makes the current move technically more interesting. The daily stochastic momentum index is around 18.80 and 2.74, and it has recently turned higher from deeply oversold territory. That is another constructive signal. The reason I find this important is that daily momentum is improving without yet reaching extreme overbought conditions. In other words, the daily chart is not currently telling me that the move has already exhausted itself. There may still be room for the trend to develop. The first major resistance I am watching is $90. That level matters both technically and psychologically. Round numbers often become important decision zones because traders, systematic strategies, and options positioning can cluster around them. If WTI approaches $90, I will not simply ask whether it touches that price. I will look at how the market behaves there. Does price get rejected immediately? Does momentum weaken? Does WTI consolidate just below 90 and build energy for another breakout? Or does it move decisively through the level and hold above it? Those details matter. If $90 is broken convincingly, the next major area I am watching on the daily chart is around $97.50, and this is where the macro story becomes much more significant. There is an enormous psychological difference between oil trading in the low 80s and oil approaching $100. Even if the economic impact is gradual, market perception can change very quickly. Once the conversation moves toward $100 oil, inflation expectations can become much more sensitive. The 4-hour chart also supports the short-term bullish structure. WTI is trading above the 14-period moving average around 82.73, the 50-period average around 81.11, and the 200-period average around 79.94. That tells me the short-term trend remains constructive. However, there is one important warning. The 4-hour stochastic momentum index has moved to approximately 78.88 and 66.56. That is clearly elevated. So, while the daily chart still has room from a momentum perspective, the shorter time frame is becoming overbought. This creates a very important distinction. A bullish trend does not mean price moves vertically higher every day. In fact, healthy trends often include pullbacks. So if WTI struggles near 87.50 or $90 and pulls back toward 82.73 or 81.11, I would not automatically interpret that as the end of the bullish structure. I would ask whether those moving averages continue to act as support. For me, 81.11 is particularly important in the short-term structure. If price starts breaking below that region and fails to recover, then the momentum structure becomes weaker. On the daily chart, the 79.43 area becomes an even more important reference point. And much further below, the $72 region represents the major swing low area that separates a normal correction from a much larger technical failure. This is how I think about risk. I do not want to predict one exact number and pretend the market must follow it. I want to know which levels confirm my scenario and which levels invalidate it. Now let us connect oil to the bond market. The US 30-year Treasury yield at around 5.31% is particularly important to me. Long-term yields are influenced by several factors. Inflation expectations matter, government borrowing matters, the supply of treasury securities matters, fiscal policy matters, and investors also demand compensation for holding long-duration bonds when uncertainty around future inflation is elevated. This means that oil is only one part of the story, but when energy prices rise while long-term yields are already at historically important levels, the combination can become problematic for risk assets. Higher long term yields increase the discount rate used to value future corporate cash flows. This matters especially for growth companies. The further into the future a company's expected profits are, the more sensitive its valuation can be to changes in interest rates. That is one reason why I watch Treasury yields very closely when analyzing technology stocks. Interestingly, technology has recently shown some resilience, supported by strong developments around artificial intelligence and semiconductor demand. But even a powerful structural theme such as AI does not exist outside the interest rate environment. If long-term yields continue rising, investors may eventually demand lower valuation multiples even from companies with strong earnings growth. This is why the equity market reaction is worth monitoring. The S&P 500 has recently pulled back around 0.5% from record territory. The Dow has also declined about 0.5%. The Nasdaq has fallen more modestly, and most sectors have been under pressure, while energy has been one of the few areas benefiting directly from higher oil prices. That market breadth tells me something. The market is not panicking. Volatility remains relatively contained. But investors are beginning to reassess the balance between growth, inflation, and interest rates. And in my view, this reassessment could become much more important if oil continues higher. Now, I want to outline three scenarios. The first scenario is what I would call the controlled oil rally. In this case, WTI trades toward 87.50 to $90, but fails to break meaningfully above that area. Oil then consolidates or pulls back. Inflation fears remain contained. Treasury yields stabilize. The Fed does not need to materially change its communication. Under that scenario, equity markets could absorb the energy shock relatively well. The second scenario is more inflationary. WTI breaks above $90 and starts moving toward 97.50. Brent remains firmly above 90. Geopolitical tensions remain elevated. Energy costs begin feeding into inflation expectations. Long-term treasury yields continue rising. In that environment, markets could start pricing fewer rate cuts, a longer period of restrictive policy, or even a renewed debate about whether the Fed may eventually need another increase. Again, I am not saying that a rate hike automatically follows. I'm saying the probability distribution changes, and financial markets react to changing probabilities. The third scenario is the most disruptive. Oil moves rapidly toward or above $100 while economic activity begins to weaken. That would create a difficult combination: slower growth together with renewed inflation pressure. Central banks dislike this environment because the policy trade-off becomes much more complicated. If they ease policy to support growth, inflation may remain elevated. If they keep policy restrictive to fight inflation, economic weakness may intensify. This is the scenario I would watch most carefully because it would challenge the relatively comfortable idea that inflation can fall while growth remains resilient. There is another variable we need to monitor: the US consumer. Recent retail sales data have shown signs of weakness, and major US retailers are preparing to report earnings. This matters because higher energy prices act almost like a tax on household budgets. If consumers spend more on fuel and transportation, they have less discretionary income available for other goods and services. So, rising oil can potentially create two pressures at the same time. It can increase inflation while weakening consumption. That is exactly why I do not look at oil only through the energy sector. I look at its impact on the entire economic system. So, what am I watching from here? First, WTI at 87.50 and then $90. Second, whether 90 becomes resistance or turns into support after a breakout. Third, the 97.50 area if the bullish trend continues. Fourth, short-term support around 82.73 and 81.11. Fifth, the more important daily support around 79.43. And outside the oil market, I am watching the US 10-year yield around 4.72% and especially the 30-year yield around 5.31%. If oil and bond yields continue rising together, I think the warning signal becomes stronger. I will also watch the Federal Reserve's communication very carefully. The market does not need an actual rate hike to become nervous. A small change in language about inflation persistence can be enough to move expectations. That is why Fed minutes, speeches, and inflation data may become increasingly important if oil stays elevated. My conclusion is simple. I do not see the current oil move as an isolated commodity rally. I see it as a potential macro catalyst. Technically, WTI has rebuilt a bullish structure above its major moving averages. The daily momentum still has room to extend. The 4-hour chart is more stretched, so short-term pullbacks would be completely normal. But as long as the key support structure holds, $90 remains the level I am watching most closely. If 90 is broken decisively, 97.50 becomes technically relevant. And if oil begins approaching $100, the conversation changes. At that point, the question is no longer simply how much further oil can rise. The real question becomes how higher energy prices change inflation expectations, bond yields, and Federal Reserve policy. And that, in my view, is where this story becomes important for everyone, not just oil traders. I will continue to follow the levels rather than trying to predict every market move. Because in markets, I believe the most useful approach is not to claim certainty. It is to define scenarios, identify the levels that confirm or invalidate those scenarios, and manage risk accordingly. If you found this analysis useful, you can subscribe to the channel and turn on notifications. I will continue covering oil, gold, global equity markets, interest rates, and the macroeconomic developments that connect them. Thank you for watching, and I will see you in the next video.